Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at net tangible assets. As we do in each one of these fundamental analysis tutorial videos, I'll give you the actual definition and then we'll go on to look at some examples and give you more insight. Net tangible assets are calculated as the total assets of a company minus any intangible assets such as goodwill, patents, and trademarks, less all liabilities and the par value of preferred stock. Remember, you have to subtract the par value of preferred stock. Net tangible assets are also known as net asset value or book value. Now let's look at an example. For this example, we'll be looking at Walmart Stores Incorporated, the balance sheet, the annual data here, and we're looking at the net tangible assets. So you're going to find at the very bottom of the balance sheet under the shareholders equity section. You'll notice, you get down there at the very bottom, break out the tools right quick. You can see shareholders equity sections here, and then very bottom you have net tangible assets. This is the actual true book value. And we talked about total shareholders equity in the previous video, and we talked about how people refer to that as being book value, and we showed you how they do that. And then we're showing you today the actual net tangible assets, and this is true book value. And this one, of course, is simply this figure here, total shareholders equity, less they've subtracted the intangible assets and goodwill, because goodwill is also an intangible asset, but they've also subtracted preferred stock. Now, if you were to check it out, and I'll show you in a moment, but if you were to check the math on that, you would find that it holds up. But the only reason why Yahoo Finance holds up is because the preferred stock section here on the Walmart shows there is no preferred stock under either one of these items here. So they're subtracting 0, and therefore they're getting the correct number. However, when I show you another example, I've already looked at Wells Fargo, they're actually miscalculating this one as well. So again, I want to give a warning. Whenever you're really seriously investing, especially when you're doing fundamental analysis and you're looking for information on your balance sheets and so forth and so on, you can glance at the balance sheets provided at Yahoo Finance, Google Finance, etc. But real investors are going to go get the actual information from the horse's mouth. So they're going to go to the company and see what they're reporting to the SEC, or be actually reading the annual reports put out to shareholders. So it's important you check your numbers. Don't just take this stuff as being the truth, because in many cases, as I've shown you throughout these videos, Yahoo Finance will have flawed data, or will have missing data, and or even in this particular case, a messed up calculation. So that's important for you to pay attention to. Okay, let's clean that up. All right, let's show you one more time the quick math on how to get the net tangible assets, and then we'll go on to give you a little more insight into it. Net tangible assets, like I said, as in the definition pointed out, you simply take the total assets, and then you're going to subtract from that total assets figure. You're going to be subtracting the goodwill, because that is an intangible asset, so this number gets pulled out of it, and then any other intangible assets that would be subtracted from that total assets. Then you take that figure, move down to the total liabilities, subtract the total liabilities from that figure. Then you would subtract any preferred stock equity, because that was not going to apply to common shareholders, common stock shareholders. So you're going to be subtracting that figure. Any case that you would have, you would subtract that, and that would leave you with the net tangible assets. You could then take this figure and go to the key statistic data over here on Yahoo Finance, or wherever you would be getting that information. You can go to this key statistics area here, scroll on down, and divide that figure by the shares outstanding, and that would give you true book value per share for Walmart stock as of the most recent reported period. Okay. As we discussed in yesterday's video when we were talking about the line item that Yahoo Finance uses as book value and how that's flawed, but it's widely used and very common to see it reported that way, so keep that in mind. But the difference will of course be the fact that the true book value that we're showing you with net tangible assets actually accounts for the fact that they've pulled out the intangibles, such as the goodwill and other intangible items. And that's important because there's a lot of manipulation that can happen with such things as goodwill and things like that, because they're hard to actually put an accurate price on. So when you have an intangible, it's, you can't see it, you can't feel it, it's difficult to price what that's worth. And so there's also a lot of times where management will manipulate that figure to make it look better on their books. So really value investors will often look at that and say, okay, I want the nuts and bolts, the very best, the strongest figure I can get, and the book value reported here on Yahoo Finance is including intangibles, and so that's why they would be using net tangible assets rather than be looking at total shareholders equity. So let's move on back to the balance sheet and show you something else real quick. Alright, let's go on down here. Now, it's important to note that a lot of times people will talk about, looking for opportunities they can buy a stock is trading at its net tangible asset value per share or lower, and they feel very confident in those scenarios because they know that if the company were to get in trouble, they could sell off all their assets, pay off their liabilities, and because they're not counting intangible assets, they feel pretty confident they can get the value reported on the balance sheet for their hard assets, and then there would be something left over to give to the shareholder, right? And that's the logic there. And that has held up for a long time. But recently, I'd say over the past 20 years, that argument has been really shot to heck. So let me show you what's going on. Okay, to thoroughly explain what I'm about to do, I'm going to have to give you guys an example here, and I'm give you two fictitious companies. And I want you to imagine these two companies are identical in every way except for what I'm about to show you. They are in the same industry. They have every detail about the two companies are identical. The only difference between Company A and Company B would be the tangible assets and the intangible assets. Now, pay attention that the earnings for both companies is $100,000 in both cases. They're making the exact same amount of money. Total assets are $1 million in both cases. And the only difference would be, of course, tangible assets for Company A is $800,000, while tangible assets for Company B is $200,000. Intangible assets would be $200,000, exact opposite here, and then you have intangible assets on Company B as being $800,000. So all we did was we flipped the scenario between these two, okay, tangibles and intangibles. Now, if you'd like to take a moment to pause this video and just analyze this information here and try to figure out which company you would prefer to own, I'd recommend you do that just to see where you stand. And then I'm going to show you the actual perspective from two different very successful investors. Okay, the old school theory here, the concept, was widely used by Benjamin Graham, who, as you know, was Warren Buffett's teacher. And he looked at Company A as being a better investment than Company B because of the fact that the tangible assets were greater in Company A. And so he felt that in a situation where he had bought a company and the company goes under or gets liquidated, the intangible assets would not really be worth anything. So all he would have access to would be the cash value of the tangible assets, $800,000, and that would go to the shareholders of common stock, right? All right, so and that was the logic there. It was just like a safety, and it makes a lot of sense being that Benjamin Graham always analyzed things from a bond investor's perspective. But then, about 20 years ago, Warren Buffett approached this argument from a different perspective. He said, in this way, it was that the earnings we know for both companies are equal. We also know that the earnings of a company are generated for the most part from their tangible assets. For example, a Ford Motor Company really can't make money selling cars if they don't have the supplies to build the cars, if they don't have the product, the plant, the equipment, so forth and so on, all the tangible assets. So he would look at this and say that the intangible assets in this particular case would not have any bearing on the earnings. And so what really goes on is he looks at it and he says, well, this company, Company A, is making $100,000 off of tangible assets of $800,000. That is a 12.5% rate of return on tangible assets. He looks over here and he can say that tangible assets for Company B are $200,000. He's earning $100,000, so he knows that he's got a tangible asset return on that tangible assets of 50%. So that's a very different way of looking at the problem. But it also points out that he says, whenever you're looking at a company, you think about both how secure it is, but also the growth potential for the future. So when you're looking at this, you can say that if this company were able to retain 100% of its earnings and reinvest it into the tangible asset, back into the company to grow the earnings in the hopes of doubling those earnings, it would have to retain those earnings for 8 years using basic math to actually double the tangible assets, which would in effect double the earnings, right? Okay. Then he looks over here and he says that the Company B would have $100,000, retain that for 2 years, and you would then have $200,000 more of intangible assets, which would give you $400,000, which would double your earnings. So he would be able to double your earnings in Company B in 2 years, while it would take 8 years to do it in Company A. So it really just puts a spin on it. It's important to analyze, of course, the quality of the earnings as well as the quality of the balance sheet of the company, because you want to know that the company is strong and able to continue, but also that the earnings are strong. And if you look at both of those sides, then you'll get a better picture from an investment standpoint rather than just looking at one side of, if I'm okay, how much am I going to make if the company goes under. We're really not looking for companies to go under, so we're looking to solve that problem by analysis and then look at the company itself and say, which company do I want to own? Which one would I like to buy the entire thing of? And in this case, you obviously want to be a buyer of company B. And now you know. Okay, this now concludes the tutorial on our balance sheet. And if you've not been to our free website at perfectstockalert.com, it's right there. It's 100% free. All we ask in return, please refer a friend, and you can watch the entire tutorial video series on the balance sheet there on the website. God bless. Take care. See you in the next one. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.